Do you want to legally minimize your taxes? In an ever-changing financial landscape, the importance of smart, legal tax minimization strategies cannot be overstated. Whether you're an individual earning under $400,000 annually, or someone swimming in deeper financial waters, there's no denying that keeping more of your hard-earned money is preferable to handing it over to the IRS. This video is about exploring ways to reduce your tax liability, the legal way, no secret methods, no illegal tactics. Instead, we're focusing on legitimate strategies to chip away at your tax bill, ensuring you can sleep peacefully knowing you've saved money within the bounds of the law. From maximizing retirement plans to utilizing commuter benefits, we'll delve into a variety of strategies designed to help you keep more of what you earn. So let's dive into the strategies that can help you keep more of your hard-earned money. First, let's look at some common benefits you might be overlooking. Commuter benefits, retirement plans, and health savings accounts can all help lower your taxable income, but they're often underutilized. Let's break them down. Commuter benefits are a kind of workplace perk that can save you money on getting to and from work. If your employer offers this, you could receive up to $300 tax-free each month to cover commuting costs. That's a potential annual saving of up to $3,600 that's not subject to tax. Next up, retirement plans. If your workplace offers a 401(k) or 403(b) plan, take advantage of it. The money you contribute to these plans is pre-tax, reducing your taxable income for the year. Plus, it's a smart move for your future financial security. The sooner you start saving for retirement, the more time your money has to grow. Health savings accounts, or HSAs, are another great way to lower your taxable income. If you're enrolled in a high-deductible health plan, you can contribute to an HSA. The money you put in is tax-deductible, and it comes out tax-free when you use it for qualified medical expenses. It's a win-win. You save on taxes now, and have money set aside for future healthcare costs. Each of these benefits has its own set of rules and limits, so it's important to understand them fully before you start contributing. But when used correctly, they can make a significant difference in your tax bill. So don't overlook these opportunities. They're there for a reason, to help you keep more of your hard-earned money in your pocket. Remember, the goal here is not to avoid paying taxes. It's about understanding the tax code and using it to your advantage, legally and ethically. Always consult with a tax professional if you're unsure about anything. These common benefits can make a significant difference in your tax bill, so take some time to understand them, make the most of them, and watch your savings grow. Now, let's talk about flexible spending accounts. A flexible spending account, or FSA, is a special account you put money into that you use to pay for certain out-of-pocket healthcare costs. The beauty of it is that you don't pay taxes on this money. This means you'll save an amount equal to the taxes you would have paid on the money you set aside. Now let's delve into dependent care FSAs. These accounts are similar to regular FSAs, but they're designed for costs associated with dependent care. This can be particularly useful if you have children who require daycare or if you're caring for older dependents. By using pre-tax dollars for these expenses, you can significantly reduce your taxable income. Take note though, FSAs often come with a use it or lose it provision. This means you need to spend all the money in your FSA within the plan year. Being strategic with how you pay for healthcare and dependent care can lead to tax savings. Opening. Next, let's turn our attention to your investments. In the world of finance, not all is sunshine and rainbows. There are times when your investments might not perform as expected and you find yourself facing capital losses. However, these losses aren't just bad news. They can actually play a crucial part in your tax strategy. When you sell an investment for less than what you paid for it, that's a capital loss. Now, these losses can be used to offset your capital gains, reducing your taxable income. For instance, if you have a capital gain of $10,000 and a capital loss of $4,000, you would only have to pay taxes on $6,000. But what if your losses exceed your gains? Well, you can use up to $3,000 of your net capital losses to reduce your other income. And if your losses are even greater than that, you can carry them over to future years until they're fully deducted. Now, let's shift gears and talk about long-term capital gains. These are the profits from selling an asset you've held for more than a year. They're taxed at a lower rate than short-term gains, which are taxed as regular income. Long-term capital gains tax rates are 0, 15, or 20%, depending on your income. The higher your income, the higher the rate. But even at the highest rate, it's still less than the maximum income tax rate. So if you're planning to sell an asset that's appreciated in value, consider holding on to it for at least a year. This way, you'll benefit from the lower tax rates on long-term capital gains. Remember, it's not just about making profitable investments, it's also about making tax-smart decisions. By strategically managing your capital losses and holding onto your assets for the long term, you can significantly minimize your tax liability. Closing, smart investment strategies can help you minimize your taxes. Finally, let's go over some lesser-known tips for tax minimization. Reviewing your 1099-B forms is an important step. These forms report income from broker and barter exchanges. Ensure these forms are accurate to avoid overpaying taxes. Next, consider margin interest. If you're an investor who borrows money to buy securities, don't forget to deduct the margin interest. It's an often overlooked tax-saving tactic. For all you gamblers out there, did you know you can offset your gambling winnings with documented losses? It's true. So, keep track of those losses for tax purposes. Contributing to a traditional IRA can also be beneficial. Depending on your income, filing status, and whether you're covered by a retirement plan at work, your contributions may be tax deductible. Now let's talk about 529 plans. These savings plans are not deductible on federal taxes, but they often offer state tax benefits. Plus, they allow for tax-free growth, a significant advantage for long-term savings, especially for education expenses. Adjusting your W-4 payroll settings is another crucial step. By ensuring the right amount of tax is withheld from your paycheck, you can avoid underpayment penalties at tax time. Lastly, consider the minimal rental use rule. If you rent out your home for 14 days or less annually, that income is tax-free. It's a great way to make a little extra cash without increasing your tax liability. Remember, every bit helps when it comes to reducing your taxes. These lesser-known strategies may not make headlines, but they can make a significant difference in your final tax bill. These tips can help you further reduce your tax liability. So, take advantage of them and start planning for a financially secure future. Keep more of your hard-earned money in your pocket, not in Uncle Sam's. It's your money after all. You've earned it, so why not keep as much of it as you can? With these tips in your tax-saving toolbox, you're well on your way to a lower tax bill. So here's to your financial success, and remember, it's not about how much you make, it's about how much you keep. In conclusion, there are many strategies you can use to minimize your taxes legally. We've covered a range of approaches, from taking advantage of workplace commuter benefits to maximizing contributions to your retirement plans. Remember, up to $300 monthly can be tax-free with the former, while the latter provides both immediate tax savings and future financial security. We delved into the benefits of health savings accounts, HSAs, and flexible spending accounts, FSAs too. These tools allow you to contribute pre-tax dollars towards your healthcare expenses. And let's not forget the dependent care FSAs, which can help you cover childcare and dependent care with pre-tax dollars. If you're dabbling in the stock market or cryptocurrency, don't overlook the potential tax deductions from capital losses. And for assets held over a year, long-term capital gains can offer lower tax rates. Remember to ensure the accuracy of your 1099-B forms to avoid overpaying taxes, and don't forget to deduct margin interest from your investments. Even gambling losses can offset winnings for tax purposes if documented correctly. Traditional IRA contributions and 529 plans can also offer tax benefits depending on your situation. And by adjusting your W-4 payroll settings, you can avoid underpayment penalties. Lastly, the minimal rental use rule is a nifty one. Income from renting your home for 14 days or less annually is tax-free. I hope this video has shed light on the myriad of legal strategies available to minimize your taxes. It's always a good idea to consult with your accountant when implementing these tactics, and if you don't have one, consider seeking professional advice to maximize your savings. Remember to enjoy and share your savings. It's not just about saving money, it's about making the most of what you've saved. Subscribe for more financial insights and have a great day knowing you're making informed decisions for your financial future.